If you want to understand what is happening in gold right now, you have to stop reading the chart the way a trader reads a chart and start reading it the way a lender reads collateral. That is the whole story. Most people look at gold falling in the middle of war and they think the metal has betrayed them. They think a safe haven failed. They think the thesis broke. I think that is the wrong frame completely. Gold did not fail. Gold was dragged into a sovereign margin call. And if you do not understand that mechanism, you are going to do what weak hands always do in every serious reset. You are going to confuse forced selling with changed value. You are going to confuse collateral liquidation with a broken long-term case. You are going to look at the smoke and miss the machine that created it. I have spent my life around markets, and one lesson shows up in every decade in a different costume when the pressure inside a financial system gets too high. The assets that people thought were untouchable are the very assets they are forced to sell first, not because they hate them, not because they stopped believing in them, because they are liquid, because they are trusted, because they can still be turned into the thing the system suddenly needs most. In this case, the thing the system suddenly needs most is dollars. That is why I want you to wipe away the lazy explanation that gold is simply correcting, because it ran too far too fast. That is part of the surface. It is not the engine. The engine is that a war in the Middle East changed the flow, changed the pressure on currencies, and turned central banks that had spent years accumulating gold into emergency sellers of the same asset they were trying to protect. Once you see that, the whole picture changes. You stop asking, why is gold down? You start asking, who is being forced to sell? How much more can they sell? And what happens when the forced selling ends? That is a very different question. And in markets, the quality of your answer usually depends on the quality of the question. Let me put it bluntly. Most people who own gold still think like tourists. They think in slogans, inflation hedge, crisis metal, central banks are buying, dollar down, gold up. Those phrases are not always wrong, but they are too small for what is happening now. Gold is not just a shiny insurance policy. In a stressed world, gold becomes collateral of last resort. And when collateral of last resort starts moving, you are no longer watching a normal pullback. You are watching sovereign balance sheets being forced to breathe through a much narrower tube. That is the setup. The first thing you have to understand is what I call the dollar faucet problem. Countries do not settle global stress with good intentions. They settle it with dollars. Oil is priced in dollars. Energy contracts clear in dollars. Defense purchases happen in dollars. Emergency imports happen in dollars. When the geopolitical system gets hit hard enough, the countries that need energy and imported essentials do not get to pay with theory. They need hard settlement currency. For years, several central banks were accumulating gold precisely because they wanted less dependence on the dollar system. That trend made sense to me once the world saw that reserve assets inside the Western system could be frozen. Every policymaker with a pulse started asking the same question. If my reserves can be blocked with a keystroke, do I really own them? Gold became the obvious answer because gold has no counterparty sitting on the other side of the table. Nobody can print it. Nobody can sanction a bar in your own vault with the same ease as a digit on a screen. That strategic logic did not disappear. That is important. Hold on to it, because what happened next confused almost everybody. The same countries that spent years stacking gold ran into a wartime dollar squeeze. The faucet that normally fills the system with export dollars weakened in some places, while the drain that sends dollars out for energy, imports, defense, and capital flight got much wider. Once that happens, you are no longer in strategy, you are in survival. Turkey is the cleanest example because the pressure became visible so quickly. A country that imports the overwhelming majority of its energy is not running an abstract macro debate when oil jumps. It is getting a bill. And that bill does not arrive gently. If oil surges and your currency is under pressure and inflation is already chewing through confidence, you have three choices, and all three are ugly. You can let the currency break and invite a political firestorm at home. You can burn through scarce dollar reserves and hope the pressure passes before confidence does. Or you can sell the thing you spent years buying, your gold, and turn it into the dollars you need to stop the bleeding for another week. That third choice is what people are finally seeing now. And because they are finally seeing it, they think it just became true. No, it became visible. That is different. I want you to imagine a man who spent a decade storing food in his basement because he did not trust the outside world. Then a storm, the roads close, and suddenly he starts opening the basement and carrying food upstairs. An outsider looking through the window says, "Well, I guess he no longer values food. That outsider is an idiot. The whole reason he stored the food was for the moment when he had no choice but to use it." Gold is working the same way. Turkey did not abandon gold. Turkey reached for gold because the machine was under strain. That is why I call this the collateral illusion. People see the collateral being sold and conclude the owner changed his view. In reality, the owner is proving how valuable the collateral is by selling it to meet an obligation that cannot be postponed. Now go one layer deeper, because Turkey is not even the whole story. The Gulf matters even more because the Gulf sits inside a different mechanism. And if you do not understand that mechanism, you will not understand why rumors of selling matter even when official confirmation trails the truth. I call this the peg defense loop. A currency peg is a promise. It says our money will remain linked to the dollar at this level because we will defend it with our reserves. That promise works beautifully when the bathtub is full. Oil revenues pour in, dollar reserves stay healthy, imports and outflows happen, but the incoming stream is large enough to keep the levels stable. Then a shock hits. Shipping lanes are threatened. Export routes are disrupted. Military costs rise. Insurance costs rise. Import costs rise. Capital gets nervous. Businesses move dollars abroad. Wealthy families move dollars abroad. Investors hedge. Suddenly the faucet is weaker and the drain is wider. The central bank can keep the peg only by pouring more dollars into the hole. Where do those dollars come from if the oil money is arriving slower and the outflows are accelerating? They come from reserves, and if reserves are not enough, or officials do not want the world to watch them drain at a humiliating pace, then gold becomes the emergency collateral that can be swapped or sold for the dollars required to keep the promise alive. That is the peg defense loop. The peg is not defended by confidence alone. It is defended by assets that can be sacrificed fast enough to keep confidence from cracking. Now, do you see why the phrase margin call is not sensational language here? A retail trader gets margin called when the collateral in the account is no longer enough to support the position. The broker sells what can be sold to meet the obligation. A sovereign balance sheet experiences the same logic at a larger and more political scale. The collateral is gold. The position is the currency system, the import bill, the defense commitment, the social contract, the entire domestic political promise that things remain orderly. When stress rises fast enough, the country does not get to ask what it would prefer to sell. It sells what can actually raise dollars. That is why gold falls in a war, even though gold is one of the few assets whose long-term reason for existing is strengthened by the same war. That sentence sounds contradictory until you understand time horizon and compulsion. In the short run, compulsion wins. In the long run, logic wins. A lot of people in markets get wiped out because they cannot hold those two truths in their head at the same time. Now, add the third force, because this is where the near-term pressure becomes heavier than most gold enthusiasts expected. Russia is moving toward a structure that restricts the free outward movement of gold, that does two things at once. Before the gate closes, it encourages liquidation by holders who do not want their asset trapped. After the gate closes, it removes future flexibility and can tighten available international supply. The same event creates selling now and scarcity later. Again, weak hands only see the first half. The market keeps doing this to people. It gives them a fact with a short-term face and a long-term face. Most people react to whichever face is shouting louder that day. I prefer to ask which face will still matter after the shouting stops. Now step back and look at the structure of the current gold market as a whole. For several years, central banks were among the strongest consistent buyers in the world. Not because they were chasing momentum, and not because they suddenly became gold bugs. They were reallocating away from a reserve architecture that had revealed itself to be political. Not neutral, that was phase one of this bull market: quiet accumulation, methodical repositioning, serious institutions moving before the crowd understood the reason. Then comes a geopolitical shock severe enough to reverse some of those flows temporarily. Energy importers need dollars. Peg defenders need dollars. War funders need dollars. Export restrictions distort flows. Rumors of sovereign selling weigh on sentiment. The same public that arrives late to every cycle looks at the price and concludes the bull market must have ended. That is phase two. Forced liquidation inside an intact strategic trend. Most people never get rich in major cycles because they cannot tell the difference between a trend reversing and a trend resetting. A reversal means the underlying reason changed. A reset means the underlying reason stayed the same, but weak holders and forced holders have to be cleared before the next leg can begin. That distinction is worth a fortune. I have seen enough cycles to tell you that the market almost always hides the most important opportunity inside an emotionally unpleasant package. It does not ring a bell and say, now the intelligent accumulation window is open. It gives you falling prices, ugly headlines, frightened commentators, and 100 plausible reasons to believe the whole thing is over. Then, after the forced selling exhausts itself, after the obligations get met or eased, after the panic loses oxygen, the same people who sold in disgust come back at much higher prices and tell themselves they are being prudent because now the trend is obvious. That is not prudence. That is late emotional confirmation. It is one of the most expensive habits in finance. I want to make this even more concrete for you, because if you only hear this as philosophy, you will forget it. The next time the chart turns red, what drives the current selling is finite by definition. Countries cannot sell more gold than they own. Emergency currency defense cannot keep accelerating forever without either stabilizing conditions or breaking the system in a way that changes the game entirely. War funding through reserve monetization has arithmetic limits. Pre-deadline export liquidation has a calendar limit that matters because structural demand has not disappeared. It has paused in places, been interrupted in places, and been temporarily overridden by immediate dollar need in places. Those are not the same as abandonment. This is where I want you to be more disciplined than the crowd. When an institution buys because its strategic view changed, that flow can persist for years. When an institution sells because it must meet an emergency obligation, that flow stops the moment the pressure eases or the sellable collateral runs low enough. One is open-ended, the other is self-limiting. If you do not know which type of flow you are watching, you are trading shadows. The strategic case for gold still rests on the same pillars that built the bull market in the first place. First, sovereign distrust of reserve assets that can be frozen has not vanished. If anything, it has deepened. Second, developed world fiscal arithmetic is still grotesque. Governments everywhere would love to solve their debt burden honestly. History suggests they usually solve it through a mix of inflation, repression, financial engineering, and currency dilution. Third, geopolitical fragmentation is not healing, it is spreading. In a fragmented world, neutral reserve assets become more, not less, valuable. Fourth, paper promises remain politically easy to multiply. Gold remains stubbornly hard to multiply. None of that changed because a country under pressure sold bars into London. What changed is the path, not the destination. That brings me to the most important psychological shift you need to make if you want to handle this period intelligently. Stop thinking like a passenger. Start thinking like an underwriter. A passenger looks at the price and asks, "Do I feel safe?" An underwriter looks at the balance sheet and asks, "Who is being forced to move? What collateral is available? What obligation is driving the move? And when does that obligation soften?" That is the identity flip here. If you stay a passenger, every decline feels like betrayal. If you become an underwriter, a decline becomes information. You stop asking the market for reassurance and start extracting evidence from its behavior. I like that mindset because it strips away drama and replaces it with sequence. First sequence, war raises energy stress and dollar demand. Second sequence, importers, peg defenders, and war funders scramble for dollars. Third sequence, gold moves from strategic reserve asset to emergency collateral. Fourth sequence, forced liquidation pressures, price and scares late entrants. Fifth sequence, the market starts treating an intact long-term case as if it were broken. Sixth sequence, the forced flows exhaust, the strategic logic remains, and stronger buyers re-enter a cleaner market. That is the whole map. Once you have the map, you do not need the crowd to clap for you. Now let me say something that may make some gold owners uncomfortable. Not every way of owning this theme is equally intelligent. If you own a thesis built on leverage, impatience, and emotional certainty, you do not own gold. Gold owns you. The cruelest thing about a forced liquidation phase is that it punishes the people who were most right for the wrong reasons. Someone buys miners with too much leverage, sees the long-term argument correctly, then gets carried out in the short-term reset because the position size was stupid. Someone buys metal with money that should have remained liquid for life expenses, then becomes his own forced seller. Someone buys the story only after a giant move, then discovers he never understood the mechanism at all. I have no interest in being right in a way that leaves me vulnerable to being removed before the thesis matures. That is why every serious capital allocation plan needs a protocol, not just conviction. Here is mine in plain language. First, I separate core ownership from tactical appetite. Core ownership is the part I can hold through an ugly reset without needing emotional relief or borrowed confidence. It is the part sized for sleep. It is there because the long-term logic of gold in a debt-soaked, politically fragmented, reserve-suspicious world remains strong. That core is not something I judge by whether the next 3 weeks feel good. Then I treat tactical opportunity as exactly what it is. Optional if forced selling creates better prices. I want room to act. If it creates worse prices before the turn, I want staying power. I never put myself in a position where I must be correct on timing just to remain alive. Second, I watch pressure gauges, not slogans. I want to know whether the Turkish currency is still making fresh lows. I want to know whether oil remains high enough to keep the dollar squeeze intense. I want to know whether shipping disruptions are easing or worsening. I want to know whether official and unofficial selling pressure is still building or beginning to plateau. I want to know whether the buyers who matter strategically are pausing, returning, or merely waiting. That is how you behave if you are serious. You do not chant narratives. You monitor the machine. Third, I buy in layers, not in heroic gestures. The crowd likes dramatic declarations. I bought the bottom. I sold the top. Most of that is vanity or fiction. Real money is built by buying intelligently when the reward improves relative to the risk. Then buying again if the forced flows create a better bargain while preserving enough liquidity that you never become a member of the seller class yourself. That is the discipline. And if you want the shortest version of the whole strategy, it is this. Do not become the person who is forced to sell the asset you correctly understood just because you structured your life carelessly. That lesson applies far beyond gold, but gold is teaching it particularly well right now. Now, I want to walk you through what I believe the next stages look like because people need a bridge from theory to action. The first phase is the liquidation phase. We are in it. The market is dominated by holders who are meeting obligations, not expressing preference. Price in this phase can overshoot to the downside because the seller is not negotiating intellectually. The seller is raising dollars. The second phase is stabilization. This begins when the key pressure variables stop worsening. Oil no longer climbs relentlessly. Currency stress stops accelerating. Export liquidation windows close. Emergency official selling slows from necessity to occasional. The market begins to recognize that the incremental supply hitting it is no longer expanding. This phase is frustrating because the public still feels suspicious, but the violence of the decline starts to fade. The third phase is re-entry. That is when the strategic buyers who never abandoned the long-term logic begin to rebuild, sometimes quietly at first, sometimes after waiting for cleaner conditions. By then, the metal is no longer being fed into the market by emergency sellers at the same pace, and the same crowd that called the thesis dead starts noticing the move again. That is why I keep telling people that the best opportunities rarely look emotionally safe when they first appear. Let me also address the obvious objection. What if the selling itself proves that gold is not really protection? No, it proves something else. It proves gold is liquid enough, trusted enough, and universally acceptable enough to become the thing sovereigns reach for in distress. A reserve asset that cannot be mobilized in a crisis is not a reserve asset. Gold is painful to part with precisely because it works. Think about a family that owns a productive farm and, in a cash emergency, sells one field to survive. Did the sale prove farmland was worthless? Of course not. It proved the opposite. The field had enough unquestioned value to rescue the family in an emergency. That is what reserve gold is doing. It is rescuing weak positions inside sovereign balance sheets while simultaneously preserving the long-term reason other sovereigns want it. That is why this phase is so psychologically difficult and so financially interesting. There is another point here that almost nobody respects enough. Every major bull market has to clear excess certainty. In gold, excess certainty built up because people got used to a one-way story. Central banks buying, dollar skepticism, geopolitical stress, higher targets, more applause. The market never allows a consensus thesis to deliver itself in a straight charitable line. It needs to embarrass the weak. It needs to force the overconfident to pay tuition. It needs to rediscover who actually understands the mechanism and who was renting conviction from YouTube thumbnails. That purge is not pleasant, but it is normal. And because it is normal, I would rather prepare for it than moralize about it. If you asked me what the most valuable mental model is for this period, I would give you this one. Gold is moving through a clearinghouse between immediate necessity and long-term distrust. Immediate necessity says sell collateral, raise dollars, defend the present. Long-term distrust says keep diversifying away from promises that can be frozen, diluted, or politically weaponized. The market is the place where those two impulses meet. Right now, immediate necessity is louder. That does not mean long-term distrust disappeared. It means urgency got voting rights. The intelligent investor does not marry the loudest voice of the week. He studies which voice still matters after the deadline, after the shipment, after the emergency import bill, after the peg is defended, after the panic exits. Now let me give you the practical blueprint I would want a rational person to carry away from all this. First rule, do not confuse forced supply with permanent supply. Emergency selling is large, but it is not infinite. Second rule, do not treat every seller as informed in the same way. Some sellers are strategic, some are desperate. Markets price both together for a while, and that is exactly why opportunity appears. Third rule, do not finance your thesis with fragility. No leverage you cannot comfortably absorb. No life obligations that turn you into a seller at the worst moment. No position size that demands emotional certainty. Fourth rule, watch the variables that actually drive the mechanism. Oil currency stress, shipping disruption, reserve behavior, export windows. Those are the gears. Fifth rule, accumulate like an owner, not a gambler. Layer in, leave room, stay solvent, stay calm. Sixth rule, remember that a reset is where price and conviction part ways. Weak conviction leaves, strong conviction gets paid later. I know that sounds stern. It is supposed to. Markets are not in the business of rewarding good intentions. They reward structure, discipline, and the ability to stay clear-headed while other people are trying to escape a fire through the wrong door. That is why I care so much about the difference between looking rich and being resilient. The man who needs immediate applause from his positions is usually one bad phase away from becoming an involuntary seller. The man who built his balance sheet with room, patience, and protocol can stand in front of the same red screen and behave like a buyer. That is the real divide. Not bullish versus bearish, not gold lover versus gold skeptic, resilient versus fragile. And once you see that, the whole period we are in becomes much easier to read. This is not a morality play about whether gold deserves to rise every day during war. This is a cash flow event inside a larger monetary transition. Cash flow events can push price around violently in the short run. Monetary transitions decide where the floor eventually forms and what comes after the clearing. So here is the final question I would ask you, and it is the only one that really matters. When the world forces strong assets into weak hands and then flushes them back out again, what kind of participant are you going to be? Are you going to be the frightened spectator who sees red and calls it proof? Are you going to be the leveraged believer who understands the thesis and still gets removed because he built no margin for pain? Or are you going to be the patient owner who can recognize a sovereign margin call for what it is, survive the ugly middle, and still have capital and conviction when the forced selling finally runs out? Because those are the three real identities available here. The first one gets educated by headlines. The second one gets educated by losses. The third one gets educated by structure. I know which one I prefer. I would rather hold fewer opinions and more staying power. I would rather understand the machine than worship the metal. I would rather buy from compulsion than chase applause. And I would rather spend this reset building a position in strength than spend the next leg upward, explaining to myself why I hesitated when the mechanism was sitting in plain sight. The crowd will eventually rediscover the long-term story. It always does, but only after price has moved enough to make agreement feel safe. By then, the easy money is usually gone. That is why moments like this matter. They are uncomfortable enough to test conviction, mechanical enough to be understood, and temporary enough to reward the people who keep their head while weaker holders are being marched to the window. This reset is not asking whether you like gold. It is asking whether you understand pressure. It is asking whether you know the difference between a thesis that broke and a holder who had to sell. It is asking whether you built your financial life to withstand volatility or whether you secretly arranged it so that one more wave of stress would turn you into the exact kind of seller the market is feeding on right now. That is the mirror. And whether you like it or not, the next move in your financial life will come from the answer you give it.